What is up, you guys? Michael Elefante here. Have you ever wondered what the different strategies are that investors use when investing in real estate and how each of those strategies compare to one another? And ultimately, how do people make money by investing in real estate? And lastly, how do you actually determine if one investment is better than the other? So, what metrics do real estate investors look at to see their overall return on their investment? We're going to cover all of that and even a little bit more here in this video. So we're going to go ahead and dive right in. Before we do so, if you guys don't mind throwing me a like and subscribing below, if you find any value from this content and want to see future content that is similar. So for that, I thank you guys. Okay, so what's all the hype about around real estate investment? And you've probably also heard that around 90% of the world's millionaires and even billionaires invest their money in real estate in some way, shape, or form. Now, although I cannot confirm the exact validity of that statement, I can tell you that through my own research, I have discovered that the vast majority of self-made millionaires have either built their wealth solely through real estate or real estate was part of their investment strategy. So you may find yourself asking these questions on how you actually make money in real estate and how you might become a millionaire through your own real estate investments. Now, I'm going to review the top 3 ways that the vast majority of real estate investors actually make money and build wealth in real estate. Number 1 is cash flow. Cash flow is the amount of money or revenue that you bring in from rents throughout the month, minus all of your expenses that it costs to operate the property and your debt service to the bank. Whatever you're left over with is cash flow. Now, cash flow is extremely important and something you should highly consider when investing in real estate because cash flow, once it exceeds your monthly living expenses or your lifestyle expenses, that is the point in which you become financially free. Number 2 is equity through principal paydown on the loan. So unless you buy a property in cash, which most real estate investors are not buying in cash, they're taking out a loan, putting, let's say, 20% down on a property, and they have typically a 15 to 30-year fixed mortgage to the bank. Now, within that mortgage, you have a portion that's going toward interest and a portion that's going toward principal. And if you guys are not familiar with how an amortization schedule works, over the life of the loan, you pay a little bit less in interest every single month and a little bit more in principal. And over the course of time, that principal is going to grow and grow and grow until you have paid off the loan in full and then you own the house outright. So each month you are technically gaining a little bit more in equity. So why is this important? While your cash flow is putting money into your pocket every single month, the equity gain from principal paydown on the loan is actually being paid off by your renters. So as that loan is being paid off, you are building your equity stake in that house and building up your net worth over time. Number 3 is equity gained from appreciation. And there's 2 forms of appreciation. Number 1 is forced appreciation. Forced appreciation occurs when you buy a house and then you fix it up. So maybe you buy a house that needs a lot of work. Maybe it needs new paint, new carpet, new appliances, new bathrooms, things like that. And once you complete that work and spend the money to rehab the property, the after repair value is going to be much higher in most cases than the value that you bought the property at. The difference is called forced appreciation. So you instantly gain some level of equity in the property by doing that type of rehab. The other type of appreciation is just appreciation over the long term, which honestly in my book is typically just a hedge against inflation. Now, if you're in a growing area like Austin, Texas, Nashville, Tennessee, and all these other regional cities that are growing like weeds right now, then you are likely going to outpace inflation and be able to capture additional equity from appreciation over the near term and the long term. So in addition to the equity gain from principal paydown, we have equity gain through forced appreciation or natural appreciation over the long term, and that is going to grow your wealth and your net worth. And something else that we're not going to talk about a ton in this video, but I do want to mention it, is tax benefits from depreciation and interest and other capital expenses that you guys have to spend throughout the years to maintain properties and continue to have them be operational. That's something very powerful with real estate because it will actually reduce the total amount of taxable income that you bring in through these properties. So let's review 6 of the more common real estate investment strategies. Number 1 is the traditional long-term rental. Traditional long-term rentals can range from single-family homes, duplexes, triplexes, quadplex, and larger multifamily such as apartment complexes. Most traditional investors here are going to put around 20% down on a property, and they're going to rent it out to renters either per room or per unit. Whatever rent that they collect that exceeds their operational expenses and debt service to their lender is cash flow, and they're going to reap the benefits of principal paydown and appreciation over the long term. Number 2 is short-term vacation rentals. This is where my wife and I have invested the vast majority of our money over the past year and a half because the cash flow potential can in most cases be substantially more than most traditional long-term rentals. The process is very similar. Most people are going to take a loan out from the bank, put 15 to 20% down on the property, furnish it so it does have some additional cost up front, and then you list it on sites such as Airbnb or VRBO. Now, I said the cash flow potential is higher because you are not just renting it out on a monthly lease agreement, so you're actually operating as a micro hotel, renting it out to people or families for short-term stays, typically between 2 and 7 days long. Because they are shorter stays, you can actually charge more per night than you would on a normal lease agreement. Therefore, your cash flow potential can be substantial if you are in a good location, a good market that has renters year-round. You get the same benefits as a long-term rental. You have cash flow, you have equity gain from principal paydown, and then you have equity gain through appreciation as well. Number 3, and possibly my favorite strategy, especially if you guys are a beginner out there, and this is called house hacking. House hacking is a terrific strategy, and the reason I say it's probably the number 1 strategy for beginners who are early on in their investing career is because the cost barrier to entry is considerably low compared to other rental properties. The reason for this is because in order to house hack, you have to buy a property and live in it, and then you're going to rent out either the other rooms, or perhaps if you buy a duplex or a triplex, you'll be renting out the other units to other renters. Now, you can rent out the other units as a traditional long-term lease agreement, as most property owners do that are house hacking, but you can also rent them out on Airbnb or VRBO if you're in an area that has a lot of tourism. What's really unique about this strategy is if it's your first time home purchase and you qualify for an FHA loan, which is backed by the Federal Housing Administration, then you guys can possibly put as little as 3.5% down. By putting only 3.5% down, it actually brings the cost barrier to entry much lower. What's super cool about this strategy is by renting out the other rooms in the house or the other units on the property, you are more than likely going to be able to cover the majority, if not all, of the mortgage cost. And in some cases, you can actually cash flow by making more in monthly rent than your mortgage cost itself. This is why house hacking is so powerful, because in more cases than not, it will allow you to eliminate much of, if not all of, your largest monthly living expense, which for most people is rent or mortgage costs, which is going to allow you to save that much more money every single month to invest in future properties. And the renters technically are paying off the loan for you, so you guys are gaining equity through principal paydown and capturing any appreciation over the long term without paying for a thing yourself. Number 4 is flipping houses. And most people get into flipping houses because they realize how quickly they can make a large sum of money, but do not let this fool you. There is a great deal of risk that comes with this. And while yes, you can make a ton of money potentially flipping houses if you do it right, if you do not do it right and are not tight on your budget, or the market tanks while you're holding one or multiple properties, it does bear that risk that you guys could lose a fair amount of money. So just keep that in mind if you guys are seeking to do house flipping. Now, house flippers are not necessarily looking for buy and hold investments that they can cash flow off of. Instead, they're looking for properties that they can buy at a discount that are extremely distressed and need a lot of work. In some cases, these projects can be purely cosmetic in nature and be mostly things like new paint, new floors, new appliances, and things like that. But in other cases, they can be extremely involved in houses stripped down to the stud and completely redone from the inside out. Once they finish rehabbing the property, the after repair value, they're hoping to be substantially higher than what they bought it for, plus the rehab costs, and whatever margin they have in between what they sell it for and what they bought it for plus the costs is their profit. Now, keep in mind, you will likely pay short-term capital gains if you flip a house and sell it under 1 year. and that will be your marginal tax rate. So just keep that in mind, as it may eat away at some of your profits that you are expecting. Strategy number 5 is one of my favorites, and honestly one of the most creative and unique strategies out there. This strategy is known as the Burr Method, and that stands for buy, rehab, rent, refinance, and repeat. Now, when you go to buy a property, you're going to buy it in cash, and this can either be money you have saved up, or you can get a hard money loan, which is going to finance both the buy and the rehab portion of the house. Now, typically, when you buy a property in cash, you can get it at a discount. Now, the reason you can do this is because you're going to shorten the time from offer to close, and you're also going to more than likely eliminate a lot of the seller's closing costs when it comes to agent fees and title fees and things of that nature. Once you buy the place at a discount, you're going to then spend money rehabbing it. So similar to that of house flipping, you're going to more than likely be looking for a property that's distressed, whether it's cosmetic or more involved, and you're going to put some money into the property to increase the value of the property. After you have rehabbed it, you're going to rent it out, and this is most likely going to be a long-term rental. Once it's rented out, after a few months, you can go to a local bank or a lender and ask for a refinance on the property. And this is going to be a cash out refinance, meaning that you are more than likely going to be able to take out up to 80% loan to value. Now, if things go according to plan, the after repair value of the property is going to far exceed what you bought it for and the rehab costs. So if you're able to pull out 80% of that money, many cases you're actually going to be able to pull out 100% of the money that you put into the deal, leaving 20% or so of equity in the property that was created by the rehab itself. So if that was your cash, now you have it back in your pocket and you can rinse and repeat and do another investment right away, and that place is cash flowing. So you just created 20% equity in a property that's cash flowing and you pulled all your money back out. That is a really, really unique strategy. Strategy number 6 is wholesaling. And while I don't really consider this a form of investment, it is a very unique strategy in which someone can get started with no credit and no cash. As a wholesaler, what you're going to do is basically act as the middleman between the seller and the buyer. What you're going to do is find distressed sellers who need to get rid of a property and are struggling to find buyers in the market. And then what you're going to do is take that contract and assign it to a buyer who is motivated to buy a place, whether that's just a normal buyer or more than likely an investor looking for a place to either flip or to fix up and rent out. Since you do such a good job wholesaling the property, the seller agrees to sell it to you at a discounted value, and then you take that contract and you mark it up and sell it to the buyer at what they agree to pay it for, and whatever difference there is in between there, you are going to be able to capture as an assignment fee. Now, in many cases, this can happen extremely fast. So you will see online some people who found a ton of success wholesaling make a ton of money. I'm talking 6 figures, 7 figures, and beyond. But it is a grind, so don't let those numbers fool you. It's not easy to make that money, especially in the beginning. What's really unique about wholesaling is that your business can grow extremely quickly if you build the right network. The more properties that you find to sell to buyers, then those buyers are likely going to come back to you seeking more properties if you do a good job for them. So once you have a network of buyers, the more properties that you find from distressed sellers, you're going to be able to assign those contracts much quicker. So that is how wholesalers can build a very strong business very quickly. So those are some of the real estate strategies that the vast majority of people get started with. But you may be asking yourselves, how do you determine if one investment is good compared to another? So I'm going to run through a quick example and some of the metrics that I personally use, and honestly many of the traditional real estate investors use as well, to determine if their investment is worth their time and effort. For this, we'll be focused on rental properties, so either a traditional long-term rental or a short-term vacation rental. Now, the 2 metrics that we're going to be looking at are cash-on-cash return and total return on investment. I look at cash-on-cash return as a comparative metric to investing in something like the stock market that looks at the first year's investment on a cash basis. So what that means is the amount of cash flow that you collect throughout the first year divided by the total dollars invested out of pocket up front to get that property is your cash-on-cash return. So we compare that number with investing in a stock or maybe an index fund and seeing that grow over the first year. Most people shoot for 7 to 10% year-over-year growth. Most long-term traditional rental property owners seek 12% plus cash-on-cash return, and I personally, in the short-term rental world, look for 25 to 30% minimum cash-on-cash return. Because after all, we want our effort and our time and our money to be well worth it investing in real estate. So if we're going to get a better return on our investment in the stock market or in an index fund, then we might as well put our money over there. So that's why we look at these metrics to determine where our money is worth being spent. So let's just look at an example for a traditional long-term rental property. Let's say you invest $20,000 to obtain the property. Your cash flow every single month on average beyond what your operational costs are and your debt service to the bank comes out to $200 per month. Multiplied by 12 months, that equates to $2,400 in cash flow for the year. So in order to calculate our cash-on-cash return, we take $2,400 divided by the $20,000 invested up front, which gives us 12% cash-on-cash. So this investment would more than likely make sense because it meets most people's metric basis for cash-on-cash return of 12%. But here's why real estate gets extremely exciting in building wealth long term. We want to look beyond just the cash return metric and look at more of a holistic investment in building wealth over the course of time. Now we talk about total return on investment, which accounts for not only the cash flow for the year, but also the equity gain from principal paydown and any equity gain from both forced appreciation and natural appreciation over time. So assuming this was a $100,000 house and we put 20% down in the form of down payment, so that's $20,000 out of pocket on a loan with a 4% interest rate, that will leave us with a mortgage. And if you guys go on any online mortgage calculator and look at the amortization schedule for this, what we're going to do is add up the first 12 months of principal payments, and we're going to add this to our cash flow in order to get total return on investment. So this should be right around $1,404 for the first year in equity gained from principal paydown. And let's just assume a baseline 3% year-over-year appreciation growth. So for the first year, if the house appreciates at 3%, then that $100,000 house is now worth $103,000. So the equity gain from appreciation is $3,000. Now to calculate the total return on investment, we need to add these three figures up, which brings us to a total of $6,804 for the first year. And we're going to divide that by the $20,000 invested up front. This leaves us with a 34.02 total return on our investment, which is amazing. And honestly, it's what makes investing in rental properties and real estate in general extremely, extremely exciting. So to recap, investing in rental properties can provide you guys with cash flow, which can eventually set you financially free. And can provide you with equity gain from principal paydown and equity gain through appreciation, which can help build your wealth significantly over the course of time. What strategies are you guys most interested in? What strategies have you already done before, and what strategies are you looking to do in the upcoming years? I'd love to hear from you guys. Drop your comments below. Drop any questions that you have. I love hearing from y'all and interacting with you guys in the comment section. If you guys haven't subscribed yet and want to see similar content in the future, feel free to subscribe below. But if not, I hope to see everybody out there again at some point in the future. Thank you guys again for watching.